this is the end.
Hey folks, CA Rachana Ranade here, and I welcome you all to a very informative video. You know what you saw in the previous section of the video was that funny moment that happened in our office today morning. So I thought, why not shoot that part? And it was so relevant to today's video because when I talk about today's video, you will get many of you might have already understood what I'm talking about, right? Of course, I'm talking about shopping from Zudio, and I'm talking about the company Trent Limited. In today's video, we are going to talk about so many more points because those who have been tracking the stock, they know about the massive rise in the stock, wherein the stock went up by almost 600% in barely 1 to 2 years. But then the stock corrected by almost 50 to 60% in the next few months. So in today's video, we are going to focus on 6 points. First, we'll understand the history of the company, then we'll talk about the business model, then we'll try and understand what led to this massive rally. We will then move about the reasons why the stock corrected by such a huge percentage, and ultimately we'll talk about the Q4 update and the way forward for this stock. The video is going to be extremely informative. Keep on watching the video till the end. Now, before we get into the financials, let me tell you the history of the company in a fun-filled manner. Trent was originally incorporated as Lakme back in 1952. Yes, the same Lakme you know from your makeup kits. But in 1998, Tata Group made a bold strategic call. They sold Lakme brand to HUL and used these proceeds to acquire Westside, pivoting the entire company into retail. And that's how Trent was born as we know it today. From there, the journey has been absolutely remarkable. Westside in 1998, Zudio in 2016, Zudio International in 2024, and their newest brand, Burnt Toast, in 2025. And the scale today? As at March 2026, Trent operates over 1,263 fashion stores across India and UAE, 300 Westside stores, and 963 Zudio stores. Now that you have understood about the history of the company in a fun-filled manner, now let's understand the business model. Where does the company actually drive their revenue from? So first and foremost, before we go into the segmental details, you need to understand Trent Limited is engaged in the retailing of what? Apparel, footwear, accessories, toys, games, food, grocery, and non-food products through various of its retail formats or concepts, right? So they are into selling of so many things. Agreed. But when it comes to Trent, I'm sure 2 3 brands immediately come to your mind. The very first one being Zudio. And it is very logical. Why? Because this one drives up almost 55 to 60% of their revenue. Now, what makes Zudio so much special? Why was it able to attract so many customers? There are reasons for that. Number one is the price point that they chose. The average price point is around 500 to 700 rupees. In fact, when I was discussing today with my team members, some of them told me that you get t-shirts even at 200 rupees at Zudio stores. And even I was like, really? I have never seen t-shirts at 200 rupees otherwise at bigger outlets. So this is something that attracted college students. It attracted young professionals irrespective of whether they were in tier 1, tier 2 or tier 3 cities. The philosophy that they used was that they have to renew fresh stock every single week, so that whenever a customer walks in, that customer should get a feeling that, oh, new stock, new arrivals, and that too at discounted prices. No customer has to wait for end of season sale per se. There may be 1 or 2 end of season sales, but otherwise they have focused on renewing their stocks based on current fashion. And very important, whatever they sell in their studio or in their shop, all are private labels. What does it mean? They are not selling other company labels in their own shop, and that is where it helps them to get more and more margins as well. We are going to talk about this point later, but I hope you have understood why the revenue is on a higher the revenue contribution is higher side from Zudio. Let's move on to West Side now. West Side contributes to 30 to 35% of the revenue, and for this one it's not absolutely college going students and all. Like, here we talk about mid to premium fashion and lifestyle. Now here they do have their own labels, but the focus is also on online sale, which accounts to roughly 6% of Westside revenues. They also have Weststyle Club loyalty program that drives repeat purchases. So I hope you have understood that the segments are different, the customer segments are different for Zudio as well as Westside. Talking about the third one, which is Star or Grocery, that accounts for roughly 8 to 10% of their revenue. revenue, and here also their own brands contribute to more than 70% of the star revenues. So this is also something pretty interesting. These are the three major segmental revenues for the company. And if I were to talk about just other concepts, you can see a bunch of brands on screen right now. One that caught my attention was Pome. I hope I'm pronouncing it properly, which is about lab grown diamonds. And they have started this in 2024, because others you already know about it. It is into fashion, accessories, and all that. Okay. So now that you know about the history of the company, you understand where does the revenue come from. The key question, what led to the rise of Trent, is what we are going to understand in the next section of the video. The very first one is 100% private label. So that's what the point I told you just in the previous section, right? For example, if I'm talking about Shopper Stop, they sell multiple branded clothing. But if I'm talking about Zudio, all the brands which are sold in Zudio store are 100% owned by them only. Will this increase their profit margins? Obviously, yes. And it is very clear that their margins are far superior than other multi-brand outlets. Okay, so that is the very first point that led their growth. The second point is no discounting strategy. The point that I told you, no customer has to wait for the end of season sale. Anyways, the average price is going to be around 500 to 700 rupees, or maybe even lower than that. In that case, what does the customer intend is that, nice, I'm shopping in a shopping mall, plus I'm getting trendy designs. Every week I'm getting some nice designs, and that is where the decision making friction is less. The customer enters, likes a specific design, buys it, gone. Okay, but the question is that how can they ensure that new designs are introduced in the store every single week? And that is where they have a very nice manufacturing and sourcing strategy, and also a design strategy. Now, when it comes to their creative team, Trent has their own in-house creating team who will have all the new designs on their design board. When it comes to manufacturing, they have outsourced the manufacturing process, but here they have very strict specifications on how clothes will be manufactured. So what happens is, stage 1 is the designing, which happens in house. Stage 2 is getting these clothes manufactured, which happens through contract manufacturing. And ultimately, once the clothes are made, they are brought to the shelf in different stores. Now for them, the design to shelf number of days is as low as 12 days, and if I were to compare it with the industry standards, that's somewhere around 45 to 60 days. So with this reduction in the overall timeline, this helps them to renew their stock every single week, or maybe every alternate week at least. The next point is about the franchisee owned and company operated stores, or very commonly known as FOCO, franchisee owned company operated model. Now what happens here is that all the major fixed costs, like buying that space, that is not on the company, that is on the franchisee. Okay, so automatically, can I say, it becomes an asset light model? Absolutely yes. Who is going to operate it? Company is going to operate that, and that is the reason why all the standardized procedures are within the company's management. So this ensures asset light model, plus it has a potential to drive higher ROCE as well. Okay, moving on to the next point, which is again extremely interesting, which is a cluster based expansion strategy, wherein they focus more on density before diversity. So you can imagine, if they were to open stores in Maharashtra, they'll not go like one in Pune, one in Mumbai, one in Nagpur, one in Satara, one in Sangli. They'll say, okay, Pune is one area, fantastic, we'll focus first on Pune. Now you can imagine, there is this area where a first store is opened, then they will try and make clusters of different stores. So different stores will be opened in comparatively closer regions. Now you can imagine that there is a one big billboard which is placed somewhere here. That single billboard can drive sales for all these outlets, which are located barely 4 or 5 kilometers from each other. Now what happens here is that driving brand awareness becomes easy. The per store marketing cost also reduces, and once they get a strong foothold, once they believe that the density is good enough here, then they'll move to newer and newer areas. That's the strategy that they adopted, which also worked in their favor. And ultimately, the biggest point I feel is filling the no man's land. This was about people, urbanization, whose incomes were increasing. Everyone wanted that aspirational buying value, but at affordable prices. So they filled in this aspirational plus affordable gap, wherein they allowed people to enter their nice stores and also at lower price points. With this, the sales exploded and it worked in their favor. So all these are the key points because of which the stock price rocketed in no time. Now, what we saw right now in the previous section was how were they able to crack the growth in sales? How were they able to expand margins? How were they able to expand the return on capital employed? How did they ensure that they had fresh designs in their stores every single week? But what leads to all these things is a PE re rating. And that is what led to the stock to zoom up further. So, what were the key pointers for the PE re rating is what we'll understand right now. The very first key trigger was India's organized retail tailwind. So always remember, when the industry itself shows positive triggers, any stocks fitting in those industries also automatically get a good push. And in spite of that push, even today, the retail penetration in the organized retail space, it is still below 30%. So when everyone saw that yes, there is rising income, yes, there is a young population, yes, there is an aspirational buying, especially post COVID, all these things led to increase in the positive sentiment in the retail organized space, and this was one of the very first key triggers for the re-rating in the stock. The second was the narrative shift from a loss making retailer to India's Zara. So this one was one of the massive narratives that we saw floating in 2022-23, where Trent got re-rated into a high growth pure play consumer compounder. And this is when the P expanded from roughly 30x P multiples in 2020 to 150 to 180x peak in somewhere around 2024. So whenever we see such massive P re-ratings, something happens, which is what we are going to discuss in the next section. But before that, what happens here is that all these expanding PEs leads to one thing, which is FOMO. For those who miss the first rally, then they enter, then few more people enter, and when big research firms give their own targets, तो और क्या ही चाहिए. Goldman Sachs had a buy rating with 8,000 rupees target. In fact, there were reports which said that Zudio will reach 1 trillion rupees in sales by FY 2035. So, with all these news floating in, FII has also entered the party. FII holding, which was around 21% in FY22, increased to 27.9% by June 2024. And when FIs are also flocking in, why would retail individual investors stay back? Why they'll say, why should FIs have all the fun? So retail individual investors also joined in the party. Investor count in the RII space grew from 1.3 lakhs to 2.8 lakhs by September 2024. Now, to add to all these things, Trent got an entry in Nifty 50. So, what happens now is that index funds, which are basically the passive investing, index funds now are forced to buy any stock which comes into Nifty 50. So, this again triggered additional buying into Trent. So, all these things, plus, anyways, it's Tata Group company. So, they have their own trust premium. All these things led to massive re rating in the stock, and that is where the stock had a dream run. But, like a stock goes up in the air, like a rocket goes up in the air, unfortunately, sometimes you also see crash landings. And that is what we saw. The stock crashed by almost 60% in a span of 5 to 6 months. Why did that happen is exactly what we'll understand in the next section of the video. The first and foremost reason I believe is extreme valuations at peak. Like I told you, the stock was trading at 150 PE, 180 PE, and when such extreme valuations are in place, what is presumed is picture perfect growth. When we have such high PEs, and in such case, if the growth dries down, if there is degrowth, these stocks take a massive beating, and that is exactly what happened with this stock. Now, if you have a look at the growth that this sales growth that this company saw somewhere between 22 and 23, have a look at this. In March 22, the sales growth was 73%. March 23, sales growth was 83%. Now, in such cases, people believe that maybe in 24, it will be more than 83% also. It may be like 85%, 90%. But what we saw in March 24 was a 50% sales growth. Now, if you just say 50% sales growth as a standalone number, that's not bad. In fact, that is great. But after back-to-back growth years of 73% growth, 83% growth, then a 50% growth with 150x valuations, with 180x valuations. In fact, a forward PE valuation was around 100x also. So with this, stock price could never sustain. In fact, for March 25, the growth went down to 38%. So I hope you have understood that when PE is extremely high, what is factored in is crazy growth is factored in. The moment you see a degrowth, the stock gets a big punishment, and that is what happened with the stock. The second point is sector rotation from high PE consumption stocks. Always remember that whenever market mood starts to dry up, that's because even this stock saw its peak point somewhere around September October 24, and that is when we also saw the market peak out. Whenever market is at peak, whenever market starts to come down, high PE stocks are the first ones to take a beating, and that is what we saw. Any sector which was trading at high PE multiples, investors moved out of those sectors and entered into different sectors. The third one was FIS selling, and in fact, that is the reason why they were coming out of these stocks, these sectors, because of the high PE multiples. But to what extent? And again, for that, if you have a look at this, you will see that FII holding, which had jumped from somewhere 21% in March 2020 to 28% in March 22. Even in fact, it was intact till 24, which was 26.8%. Look at the drop. March 25, 19.6%. December 25, it is 15.6%. And unfortunately, same time, retailers from 22.8% to 25.87%. Retailers join in the party late, and that is where a lot of people burn hands in their overall investing process. Big investors, someone like Mr. Radhakishan Damani, he also exited his stake in September 24. All these slowly and steadily just dry up the sentiment in certain stocks. Okay, so till now what we discussed was extremely high PE, sectoral rotation, FIS selling, big investor selling, growth deceleration. But apart from all these factors, there is one more factor which is extremely important, which is called as LFL. LFL is nothing but like for like. Some people know this as same stores growth also. Means what? If I were to compare the sales of two stores which have been in the market for, let's say, more than 2 years, in that case, how much percentage are they growing in their sale numbers? And earlier, when everything was good, same stores growth was good. But when in the recent few years, when we checked, the same sales growth or LFL fell down to as low as 1 to 3%. Now, with this, what happens is that, see, when number of stores increase, overall revenue is going to increase. But at a store level, the LFL goes down. It means that unless and until you do more and more expenditure, unless and until you open more and more stores, the top line is not going to grow. So this can also be called as store cannibalization. Now, what do I mean by this? See, assume I had a Zudio outlet like 5 kilometers away from my home. I used to travel till that store. But now a new store is open just 1 kilometer away from my home. My priority will be going to that store. So for the previous store, the sale number is going to drop. And for this store, even the store revenue rises for the new store over a period of 1 or 2 years, that revenue is also going to dry up because maybe a newer store is going to open there. So that is one more important point, which is store cannibalization. Again, the overall stores growth or the revenue for stores started to dry up. On top of that, what happened was rising competition. When everyone saw that, okay, they are into that very sweet spot where people are ready to spend a little bit and they want to buy at affordable prices but with good aspirational value, that is when other brands including Reliance Retail, who launched Usta, ABRFL, which launched Style Up, and Shopper Store also launched Intune. When more and more competition comes up, it's not only internal competition which is eating up into your sales, it is also external competition eating up into your sales. And ultimately, overall, with the market speaking up somewhere around September 24, the inflation slowly and steadily rising, all these also led to a muted consumer demand. All these points led to a downfall in the stock by almost 50 to 60%. But the big question now remains is, are there any good Q4 updates and what to look out for this stock in the coming few quarters? Now let's talk about the Q4 update. It's like a silver lining to the dark cloud, because if you see, the whole year's revenue growth is around 18%, but Q4 FY26 as compared to Q4 FY25, it's a 20% growth. So quarterly growth is higher than the whole year's growth. That is a good point. Even if you look at the net stores opened, if I'm talking about Westside, 22 opened in Q4 versus whole year it was only 52. For Zudio also, only in Q4, 109 stores were opened versus whole year of 198. So more and more stores being opened is obviously considered as a good sign. Now what happens is that general investors can feel that, okay, we can see some sort of turnaround, plus the stock has also corrected like 55-60%, I should jump and buy the stock. Wait, even today, the stock trades at 83 times its earnings. So 83p multiple is still a very, very big question mark here. And we also have to keep a watch on some key pointers before you take your own decisions. The very first key pointer that one should watch is what about LFL growth. Currently, if you remember, I told you it's around 1 to 3%. Ideally, that should increase to at least mid single digits. Second thing that you should watch out is about the new category profitability. They have ventured into different businesses. We should see them scale up. We should see profitability coming up into these new categories as well. And very important, though the competition is intensifying, how much would it hurt this business? That is what also we have to check out for this company. All in all, if I were to sum up, was something that went terrifically wrong in the business? No. Is the key story intact? Yes. What happened was that everyone just went gung ho about the stock. All the brokers started becoming extremely positive on the stock. A story like New India Zara started being playing out. So, all these things led to a massive rally in that stock. P skyrocketed, and ultimately, all this rally fizzled out to 55 to 60%. So what you feel about this stock? I feel that the story is intact, but things are to be checked. What do you feel? Let me know in the comment section. If you love today's video, don't forget to smash the like button. Don't forget to share this video with your friends. If you're still not subscribed to our channel, please do that as well. I'll see you in the next one. Till then, take care. Jai Hind and bye bye. You might have come across such advertisements on various social media platforms. Please note, all of these are fraudsters promising unbelievable returns through stock tips. I don't provide any calls or advisory services. I provide only educational content through my social media handles and through my website rachanaranade.com and rachanaranade.in.